SaaS company focused on HR solutions, Paycom Software reported earnings last night, and investors are not happy with what they saw. Shares are down as much as 17% as of the time of this recording. So what's going on with the company? As a shareholder myself, I want to figure that out. Caveat emptor, I'm not super worried, but let's talk about why over the next 10 minutes. And before we get to that, I want to give a shout out to YCharts for sponsoring today's video. More from them in a second. This was Paycom's second quarter of 2023, and if we look at the headline numbers, there's a lot to like. Top line grew 27% ahead of expectations. Bottom line on a non-GAAP basis grew 29% ahead of Wall Street's expectations. If we look at margins, things get a little bit hairier. Gross margins were down, but they're still well above 80%. But operating and net margins were down more meaningfully. We'll get to what that might be in just a minute. Free cash flow expanded quite a bit. Net income on a non-GAAP basis was up, and the balance sheet remains in pristine shape. Let's go ahead and look at the company's income statement step by step. What we see is total revenues were up 27%, and within that, it's worth noting that management said demand trends remain strong, particularly up market. We're going to talk a little bit about what that up market means a little bit later. Now, one ding against the company. The cost of revenues was up 35%. It's never good to see the cost of revenues growing faster than the total revenues, but with gross margins still above 80%, we're not going to ring the alarm bell yet. Total administrative expenses were up 27%, same as revenue was. It's worth noting this sales and marketing budget is going to be something to keep an eye on. Why? Because the company typically focuses on small and medium-sized businesses, and it does that by sending sales representatives into small towns at the same time, or medium-sized towns or top-tier cities, and getting them to get in the doors of these small and medium-sized businesses and convincing them to start using Paycom. And once they do, the switching costs are very high. But the other side of that coin with the switching costs being high is the fact that it takes a lot of work to get customers to switch over to what you're offering. So keep an eye on that moving forward. Now, if we work our way down, because gross margins fell, operating income was only up 21%. That's still not bad, but you want it to be faster than revenue growth of 27%. Now, there was some wonky stuff happening in the other income section, largely because of higher interest rates, which benefited the company, but that makes net income less meaningful in terms of telling us how the company is doing. So overall, what we see is that it's worth noting that shares outstanding were actually down 6%, which is meaningful for a company that gives rather generous stock-based compensation. So what about the forecast moving forward? Was there something there that can explain a 20% drop? Maybe, but overall, management's guidance for the current quarter matched Wall Street's estimates. Bottom line is expected to grow 28%. Management actually bumped up full-year guidance, albeit by very little, and it matches essentially Wall Street's estimates. So overall, there's a lot to like about what's going on. What am I going to be watching moving forward as a shareholder? Well, first, there are these comments from management that said they launched into Canada, they've opened up a large cross-border opportunity, and as they continue to expand outside of the US, they expect the move up market to continue to accelerate. Now, what does up market mean? It means that they're going after organizations with more than 10,000 employees. And because of that, they now believe that they've only scratched about 5% of their total addressable market in terms of what they've captured so far. So let's just stop for a second, talk about Paycom. What it has done more than anyone else, it is simply executed brilliantly. They send small teams to cities, they get in the door of these small and medium-sized businesses, they get them to switch over, and once they do, they stick with it because this is a very sticky product. Execution is everything. They have a track record of doing that. Now, some management companies might say, oh, look at this huge opportunity we have in front of us. There's this long runway for growth. And sometimes it's all smoke and mirrors. It is worth noting that Paycom has shown that they know how to execute. So is this just smoke and mirrors, or are they saying, hey, look, we can accomplish 20% revenue growth annually for the foreseeable future? It's possible given the company's track record. Now, what else am I going to be looking for? Well, first, I'm going to look at that revenue growth. But second, I talked about that sales and marketing budget. keep an eye on how much of gross profit that eats up. It might edge higher as they go internationally, but we want to see it not go too high, hopefully stay stable, ideally come down. Third, keep an eye on comments on international. And fourth, listen for commentary on enterprise, which again means those companies that they're signing on that have more than 10,000 employees. Overall, I believe that the moat is definitely widening around this company, and the thesis is very much on track. So what's the problem? Why are shares down so much? Well, that all comes down to valuation. And when we think about how to value the company, we've got to think about what stage of growth is it in. Now, they do have a dividend and buyback shares, so there is capital return, but they're also growing the top line by over 25%. So I would say it's somewhere between stage 4 and stage 5. When that's the case, we can look at things like price to earnings, price to forward earnings, price to free cash flow. And for that, we go to Y charts. It's a tool Brian Feroldi and I use every day. If you click on the link in the show notes below, you can start a free trial at Y charts, and if you mention Brian Feroldi's name, you can get 20% off. Now, if we look at the company's PE ratio of about 57, in no world is that cheap, and yet this is a company that is now trading for its cheapest PE ratio, about its cheapest as we've seen in 5 years. If you look at the forward PE ratio of 40, that actually seems quite reasonable. Why? Because it's growing its top line 25% and it can still meaningfully expand its margins, even though that expansion might be a few years off as they spend heavily in sales and marketing. What if we look at the company's price to free cash flow? Well, it was 71%. We throw in the growth that we just found out about today, and it's trading at about 60 times free cash flow. Look, in no world is that cheap, but there are other ways that we can explore this too, like a reverse discounted cash flow model. And for that, what we do is we head on over to this sheet and we throw in Paycom's ticker symbol. We put in its free cash flow over the past 12 months, which after today is about $300 million. Pick a terminal growth rate of 2%, which is kind of right in the middle of the road. Maybe we could even go up to 2.5%. Pick a discount rate of 10%, which means we expect a 10%, we demand a 10% return per year for this investment. And then we've got to say, okay, well, what's the implied growth rate of today's stock price? And we just have to make these two match. Is it 20%? Nope, that's not quite high enough. How about 23%? That's a little bit low. What about 22.5%? That gets pretty close, 22.5%. So what does that mean? It means that today's stock price, after that 20% haircut, is saying that the company needs to grow its free cash flow by 22.5% per year. Is that possible? I think it could be, because we're seeing the top line is growing faster than that. For now, we're talking about for 10 years, we're seeing management say that there is this big opportunity, and we know that free cash flow margins still have some room to expand. So it's certainly within the realm of possibility. In fact, if I had to say how tempting is this stock price today, what I would say is I would put it somewhere right here. If I didn't already own shares, this is a reasonable entry point for a starter position in the company. Now, as you can see, valuation can be a very tricky topic, which is why Brian Feroldi and I are excited to announce that enrollment for our course Valuation Explained Simply is open. The course starts on August 7th. We'll cover things like the business growth cycle, total addressable market, multiples, and cash flow analysis. They'll meet on Mondays and Wednesdays. This is, it's worth noting, a night class from 8 to 9:30 p.m. Eastern Standard Time. If you are interested in joining us for this course, click on the link in the show notes below. If you put in the code LASTCALL149, that says 49, it's LASTCALL149, you can get $149 off the price of this course. It is worth noting that that expires at 11:59 on August 6th. So overall, I think that the reason the stock has come down is largely based on valuation. I don't think the thesis is broken. And if you were looking for an entry point in Paycom, today offers a relatively attractive point. I already own shares, so I won't be adding to it. But overall, I don't think it's worth getting too worried about this. We'll check back in on it in 90 days. And until then, Brian, out.